Episode 1. The Architecture of Risk. This is a forensic investigation into the systemic displacement of global credit risk. By the end of this hour, you will possess the forensic skills to identify the fractures in the shadow ledger. You will understand how the 2008 global financial crisis did not eliminate risk, but hydraulically forced it into the dark. You will learn to deconstruct the mechanics of volatility laundering. Most importantly, you will see the trap being set for the retail investor before the system closes. The global financial architecture has undergone a profound structural metamorphosis. Following the collapse of Lehman Brothers, regulators promised safety. They delivered Dodd-Frank and Basel III. These were designed to fortify the balance sheets of systemically important financial institutions. They succeeded in de-risking public banks. However, the unintended consequence was the inevitable migration of credit risk into the opaque domain of private markets. This investigation posits that the golden age of private credit is a mirage. It has been sustained not by economic resilience, but by regulatory and accounting arbitrage. This hour reveals the Level 3 assets that rarely trade. We expose the Sharpe ratio mirage that attracts billions from unsuspecting bag-holders. We step inside the confidential chamber to reveal why the next credit cycle will not be absorbed by long-term capital, but will result in a chaotic, non-linear liquidation. Chapter 1. The $2 trillion shadow. To understand the crime, we must first inspect the weapon. Chapter 1 details the quantitative anatomy of a $2 trillion behemoth that replicates banking functions while evading the safety nets meant to protect you. Section 1. The post-crisis metamorphosis. The transformation of the global financial system in the post-2008 era was defined by a massive migration of credit risk. Regulatory remediation sought to de-risk the traditional banking sector. The Dodd-Frank Act and the Basel III Accord fortressed public balance sheets against solvency shocks. But risk is like water in a hydraulic system. It cannot be destroyed, only displaced. The risk moved from the regulated, transparent ledgers of public banks into the heterogeneous ecosystem of the shadow ledger. This was not an accident. It was a hydraulic inevitability. When regulators imposed heightened scrutiny on banks originating loans to highly leveraged companies, they created a vacuum. The leveraged lending guidance issued by U.S. regulators explicitly discouraged banks from lending to companies with leverage ratios exceeding 6.0x beta. Simultaneously, capital surcharge rules for global systemically important banks made holding non-investment grade debt punitively expensive. Traditional banks were forced into a strategic retrenchment. They retreated to the safety of investment-grade lending and government securities. This retrenchment created a massive liquidity vacuum in the middle-market corporate sector. Private credit funds stepped into this void. They offered speed, certainty, and flexibility that regulated banks could no longer provide. This shift represents a fundamental change in the originate-to-distribute model of the pre-2008 era. We have transitioned to an originate-to-hold model. Non-bank lenders now retain credit risk on their balance sheets until maturity. Proponents argue this aligns incentives. Forensic analysis proves it concentrates risk in opaque pools of capital. These pools are increasingly interconnected with the banking system they were meant to replace. The risk has been transmuting in the shadows for a decade. It has shifted from the visible liquidity of public bond markets to the opaque valuations of private equity-owned life insurers. The supposed separation between banks and shadow banks has eroded. Through subscription line facilities and NAV loans, the banking sector has become inextricably linked to the solvency of the shadow funds. The metamorphosis is complete. The system is now a complex, opaque, and highly interconnected complex that rehypothecates risk back into the real economy. Section 2. Defining the beast. To rigorously assess systemic risk, we must strip away marketing nomenclature. We must apply a forensic definition of shadow banking. In strict financial terms, shadow banking refers to credit intermediation that takes place outside the regulatory perimeter. It is defined by the absence of two critical public backstops. First, these entities lack access to public liquidity. Unlike commercial banks, private credit funds do not have access to the Federal Reserve's discount window. They cannot monetize assets during periods of market illiquidity. Second, they lack public liability insurance. They do not benefit from FDIC guarantees on their liabilities. Their funding base consists of equity commitments from limited partners and secured debt facilities from banks. Assignment. This is not a drill. Open your primary brokerage or banking app. Navigate to the terms of your high-yield or alternative credit income fund and search for the phrase "No FDIC insurance." The results will fundamentally change how you view your money. When you are ready, unpause. In a traditional banking crisis, the state provides a liquidity bridge. This bridge prevents a fire sale of assets. In the shadow banking system, no such bridge exists. A liquidity crunch in private credit must be resolved through market mechanisms. This primarily involves the liquidation of assets or the gating of investor redemptions. These mechanisms accelerate price declines and transmit shockwaves through the broader financial ecosystem. The shadow ledger replicates the maturity transformation of traditional banks without the requisite safety nets. It functions as a parallel banking system tailored to the needs of the private equity industry. These entities are organized largely as closed-end vehicles or BDCs under the Investment Company Act of 1940. They are not subject to banking capital adequacy rules. This allows them to offer higher leverage, often exceeding 7.00 EBITDA. They utilize unitranche structures that blend senior and junior debt into a single instrument. By late 2004, this asset class, euphemistically termed direct lending, had metastasized into a $2 trillion behemoth. The systemic implication is profound. The lack of a public backstop converts a liquidity crunch into a solvency crisis. Section 3. The velocity of growth. The quantitative dimensions of the private credit market have expanded at a velocity that outpaces traditional credit metrics. Assessing the precise size is complicated by the private nature of the assets. However, a synthesis of data provides a compelling picture of scale. From a niche segment of approximately $230 billion in 2008, the market has exploded. As of late 2004, the global private credit market is estimated to have reached approximately $1.8 trillion to $2.0 trillion in assets under management. This represents a near tripling of the market size over the last decade. The trajectory suggests continued aggressive expansion. Forecasts project the market will reach $2.8 trillion by 2028. Morgan Stanley offers a more bullish projection. They estimate the market reached $3 trillion at the start of 2025. They forecast it to metastasize to $5 trillion by 2029. Blackstone suggests the total addressable market potential could reach $30 trillion. These numbers confirm that private credit is no longer a niche alternative, but a foundational pillar of corporate finance. This growth persisted even through the aggressive interest rate tightening cycle of 2022 and 2024. Theoretically, this period should have dampened demand for floating rate finance. Instead, the influx of capital from pension funds and sovereign wealth funds searching for yield created a massive overhang of dry powder. By 2025, uninvested capital commitments exceeded $400 billion. This deployment pressure creates a perverse incentive structure regarding valuation. To attract and retain capital, managers must demonstrate consistent, positive returns with low volatility. Volatility laundering becomes a competitive necessity. A fund that honestly marks down assets during market dislocation risks investor attrition to a competitor who smooths their returns. The stability is self-reinforcing. Steady valuations attract more capital, which provides the liquidity to avoid realized defaults, further justifying the steady valuations. Section 4. The displacement of syndicated markets. The 2024 and 2025 period highlights a structural decoupling between private and public credit markets. While the broadly syndicated loan market has faced headwinds due to bank risk aversion, private credit has absorbed market share. Private credit now finances approximately 85% of all leveraged buyouts. This is a complete inversion of the pre-2008 paradigm. Previously, regulated banks led virtually all such transactions. Today, banks have been displaced. In Europe, direct lending volumes surged by 47% in 2024. In stark contrast, the syndicated loan market grew by a modest 24%. This farm-to-table model of private credit offers borrowers speed and certainty of execution. It removes flex terms, the market-driven price adjustments that characterize bank syndications. While beneficial to borrowers, this model removes the transparency of public markets. In the private market, loans are held to maturity and valued using mark-to-model methodologies rather than market prices. The implications of this displacement are profound. The deal dam of a backlog in M&A activity is flowing almost exclusively into private credit vehicles. This concentrates credit risk within asset managers who lack access to the Fed's discount window. The market is becoming increasingly concentrated among a few hyperscalers, massive firms like Blackstone, Apollo, and KKR. These firms are no longer just asset managers. They are quasi-banking institutions. They originate assets, package them, and distribute them to their own captive insurance arms and retail wealth platforms. Industry veterans warn that these hyperscalers risk eroding returns by prioritizing capacity-driven fundraising over disciplined credit selection. The need to deploy tens of billions annually creates a perverse incentive to lend into deteriorating credit conditions. This mirrors the originate-to-distribute model of 2008, but the risk is retained on the balance sheets of affiliated vehicles. Section 5. The P/PC mismatch. A critical systemic vulnerability emerges from the ratio of private equity dry powder to private credit dry powder. As of 2024, PE firms hold a record $1.6 trillion in uncalled capital. Historically, leveraged buyouts are financed with a mix of 50% equity and 50% debt. The math reveals a massive capital imbalance. Private credit dry powder stands at approximately $320 billion. Implied leverage demand, assuming a 1 debt-to-equity ratio on PE deployment, reaches $1.6 trillion. This is a 5-1 imbalance. It suggests a massive pent-up demand for debt financing that the private credit market lacks the capacity to finance. If PE sponsors attempt to deploy this capital simultaneously, the system fractures. This dynamic incentivizes private credit managers to raise capital aggressively from new sources. Specifically, they have pivoted to the retail wealth channel. This democratization of private credit is the most significant structural shift of the 2024 and 25 cycle. Semi-liquid vehicles such as non-traded BDCs and interval funds now command nearly 1/3 of the US direct lending market. This introduces a lethal liquidity mismatch. Retail investors typically require quarterly liquidity, often capped at 5%. However, the underlying assets are illiquid, 5 to 7 year loans. In a market stress scenario, the behavior of retail capital differs fundamentally from the sticky capital of pension funds. Retail capital is prone to sentiment-driven flight. This creates a new vector for run risk. If a flagship retail fund were to gate redemptions due to credit losses, it could trigger a run on the entire sector, freezing tens of billions in retail capital. The individual saver, believing they are protected, has become the designated bag holder for institutional retrenchment. So, we have now established the $2 trillion scale of a parallel banking system operating without a safety net. We have seen the 5-1 capital mismatch that is forcing risk into the retail channel. But the mastery of the current scale naturally leads us to a much darker and more immediate question. If the system is this large and this fragile, how are the managers reporting perfectly smooth returns while the rest of the world is burning? What we have just uncovered regarding institutional vulnerability is bad. It confirms the fragility of the system. But as we will irrefutably demonstrate for you in the first 10 minutes of Episode 3, the global unwind, for the retail investor, the individual saver who believes they are protected, it gets exponentially worse. In the next chapter, we step inside the regulatory vacuum to reveal the 3 unknown escape valves. We will detail the specific regulations that forced banks to retreat and allowed shadow lenders to thrive. Subscribe for the next dossier. Chapter 2: The Arbitrage Engine. To understand the crime, we must first inspect the weapon. In Chapter 2, we dissect the arbitrage engine. This is the mechanical heart of the displacement, the collection of regulatory mandates that systematically dismantled the traditional banking model to make way for the shadow ledger. We are moving inside the gears to reveal how a system designed for safety became the ultimate catalyst for the next liquidity fracture. Section 1: Basel III and Bank Retrenchment. The architectural transformation of global finance was not driven by market innovation but by regulatory mandate. Following the 2008 crisis, the Basel III international standards were implemented with a singular, clinical objective: to fortress the balance sheets of public banks. To achieve this, regulators imposed a tiered system of capital adequacy ratios and net stable funding requirements that effectively turned traditional corporate lending into an act of financial self-sabotage for regulated institutions. Under the Basel III framework, every asset held by a bank is assigned a risk weight. Government bonds, viewed through a lens of state-sanctioned optimism, carry a 0% risk weight. Conversely, corporate loans, particularly those to non-investment grade borrowers, carry a 100% risk weight or higher. This math is a death sentence for the middle market bank. For every dollar of risky corporate debt a bank holds, it must set aside an equivalent amount of high-quality Common Equity Tier 1 (CT1) capital. This created a hydraulic reality. The cost of holding non-investment grade debt became punitively expensive. Banks were faced with a choice: accept suppressed return on equity, ROE, to support the real economy, or incinerate their corporate lending divisions to satisfy the regulator. They chose the latter. We are witnessing a secular rotation where bank lending as a share of all corporate borrowing has collapsed, falling from 44% in 2020 to just 35% in 23. This strategic retrenchment was not a correction, it was a wholesale displacement of credit provision, as banks were forced to hoard high-quality liquid assets to satisfy the liquidity coverage ratio, LCR. A multi-trillion-dollar vacuum was formed in the corporate credit market. This vacuum was the birth canal for the shadow ledger. Risk was not eliminated. It was simply pushed into a domain where capital adequacy rules do not exist, and where the safety of the public is replaced by the discretion of the manager. Section 2. The 6.0x EBITDA barrier. While Basel III constricted the bank's capital, a second regulatory mechanism acted as the gatekeeper for their risk appetite: the leveraged lending guidance. In 2013, U.S. regulators, the OCC, the FDIC, and the Federal Reserve issued a directive that effectively established a ceiling for the American corporate sector. The directive was explicit. Banks were strongly discouraged from originating loans to companies with leverage ratios exceeding 6.0x EBITDA. To the forensic eye, this was the moment the middle market was handed over to shadow lenders. In a traditional banking environment, a leverage ratio of 6.0x was the standard for a healthy, growing company. By flagging anything above this threshold as unsafe, regulators effectively capped the risk appetite of the only transparent institutions in the system. While the guidance was technically non-binding, it was enforced with clinical precision through the supervisory process, effectively forcing banks to abandon the most profitable segments of corporate finance. The shadow ledger was not subject to this 6.0x barrier. Unencumbered by the Federal Reserve's supervisory scrutiny, private credit funds stepped into the void. They did not merely fill the gap, they expanded the horizon of risk, frequently offering leverage multiples exceeding 7.0x or 8.0x EBITDA. By late 24, the displacement was absolute. Approximately 85% of all leverage buyouts are now financed outside the banking system. This shift represents the systematic privatization of high-yield lending. By establishing the 6.0x barrier for banks, the state inadvertently created a protected monopoly for shadow lenders, allowing them to charge a premium for the very leverage the banks were forbidden to provide. We now face a market where the real leverage of a borrower is often obscured by EBITDA add-backs and adjusted metrics, creating a cohort of companies that are operationally fragile but balance sheet performing on paper. The 6.0x barrier didn't protect the borrower. It simply moved the debt to a ledger where the lights were turned off. Section 3. The Volcker Rule Constraint. To fully understand the capture of the corporate market, we must examine the removal of the bank's defensive tools, the Volcker Rule, a core component of the Dodd-Frank Act. delivered the final blow to the integrated banking model. It generally prohibited banking entities from engaging in proprietary trading and from owning or sponsoring hedge funds or private equity funds. The stated goal was to separate boring commercial banking from risky investment strategies. The forensic reality was the destruction of the bank's ability to compete for talent and deal flow in the alternative markets. By prohibiting banks from using their own capital to anchor private funds, regulators severed the connection between commercial lending and sophisticated credit analysis. This regulation triggered a massive migration of human capital. The elite credit analysts and risk managers who once operated within the regulated halls of JP Morgan and Goldman Sachs migrated to the hyperscalers, firms like Apollo, Blackstone, and KKR. These firms are now the quasi-banking titans of the 21st century. They are not merely investing, they are originating, packaging, and distributing credit to their own captive insurance arms and retail wealth platforms. The Volcker rule didn't stop banks from being exposed to risk. It just changed the nature of the exposure. Denied the ability to own the funds directly, banks pivoted to providing the plumbing for the very firms that displaced them. Through subscription line facilities and NAV loans, banks are now the prime brokers to the shadow economy, holding massive amounts of credit risk in the form of fund-level liabilities. The risk remains on the bank's books, but it is now one step removed, hidden behind a layer of fund documentation that regulators cannot easily pierce. Section 4. From originate to distribute to originate to hold, the 2008 crisis was defined by the failure of the originate to distribute model. Mortgages were originated by banks, sliced into securities, and sold to the public, detaching the lender from the long-term risk of the loan. We were told this model was broken. We were promised a transition to a more stable paradigm. What we received was the originate-to-hold model of private credit, a shift that has concentrated $2 trillion of risk in opaque, illiquid pools. In the shadow ledger, non-bank lenders retain the credit risk on their balance sheets until maturity. Proponents call this skin in the game. A forensic analysis identifies it as a lethal concentration of risk. Because these loans are held in private vehicles rather than sold to the public, they are never subject to the cleansing discipline of price discovery. They are valued using internal models, allowing managers to ignore market volatility and report steady returns while the underlying credit quality rots. This farm-to-table model of credit offers borrowers speed and certainty, but it removes the transparency of the public markets. In a traditional syndicated loan market, a borrower's distress is signaled by a falling price in the secondary market. In the shadow ledger, there is no secondary market. A loan is performing at par, 100 cents on the dollar, until the day it enters a hard default. This is not stability. It is the indefinite deferral of reality. This concentration of risk is compounded by the lack of a liquidity backstop. Because these funds do not have access to the Federal Reserve's discount window, they cannot monetize these illiquid assets during a market panic. They are trapped in a systemic downturn. The originate-to-hold model becomes a hold until liquidation model. The supposed alignment of incentives is revealed as a financial death pact, where the failure of one large manager can trigger a fire sale externality that depresses the asset values of every other manager in the system. Section 5. Unitranche innovation, unencumbered by the strictures of bank regulation, Shadow lenders pioneered the ultimate weapon of the displacement, the unitranche structure. Historically, a corporate acquisition was financed with layers of debt: a senior secured loan from a bank and a junior, unsecured piece from a mezzanine fund. This structure contained natural friction, as the two classes of lenders had different rights and incentives. The unitranche innovation incinerated that friction. It blends senior and junior debt into a single, highly leveraged instrument provided by a single shadow lender. It offers the borrower a Swiss Army knife of debt: one interest rate, one set of covenants, and one point of contact. But for the financial system, it represents a profound escalation of risk. Because the unitranche is provided by a non-bank entity, it frequently exceeds the leverage limits that would trigger regulatory intervention for a bank. These loans are often originated with covenant-light documentation, meaning they lack the traditional financial maintenance tests that act as an early warning system for credit deterioration. The lender has effectively traded its legal rights for higher yield, betting that the company will grow into its debt before the maturity wall hits. Pause this video right now. Open your primary brokerage app and look for the holdings of your most popular direct lending BDC. Search the prospectus for the term unitranche. Then search for no maintenance covenants. The results will reveal that you are not investing in senior debt. You are underwriting a high-leverage hybrid that has never been tested in a real liquidity freeze. When you're ready, unpause. Unitranche is the principal mechanism through which the shadow ledger has captured the upper middle market. It allows a single manager to deploy $5 billion or more into a single capital structure, bypassing the transparent price discovery of the syndicated loan market. This is not innovation. It is the engineering of a more efficient trap. By the time the flaws in these unitranche structures are revealed, the assets will have been marked at par for years, leaving the bag holders at the bottom of a cliff with no way back up. Regulatory containment created a vacuum that $2 trillion in shadow capital was eager to fill. The systems meant to protect the public from risky banks have instead systematically displaced that risk into a domain where there is no oversight, no liquidity, and no exit. Do you believe these regulations made the financial system safer, or did they simply move the danger into the dark? Let us know your take in the comments. In the next chapter, we step inside the chassis of shadow banking. We will examine the specific legal vehicles, the BDCs and interval funds, that are carrying the weight of this $2 trillion shadow, and we will reveal why they are structured to trap your capital the moment the tide turns. Subscribe for the next dossier. Chapter 3. The Chassis of Shadow Banking. To understand the crime, we must first inspect the weapon. In Chapter 3, we dissect the legal architecture that facilitates the movement of $2 trillion into the dark. This is the chassis of shadow banking, the structural framework that allows credit to be intermediated outside the reach of the Federal Reserve and the FDIC. We are moving inside the legal documentation to reveal how the very laws designed to protect small businesses were repurposed to build the shadow ledger. Section 1. The BDC legal frame. The principal vehicle carrying the weight of the private credit boom is the Business Development Company, or BDC. These entities were not birthed in the chaos of 2008, but were created by the US Congress in 1980. The original legislative intent was clinical: to stimulate the flow of capital to small, developing U.S. businesses that were underserved by traditional banks. Under the Investment Company Act of 1940, the BDC operates as a closed-end fund, but with a specific mandate. It is required by law to invest at least 70% of its total assets in eligible portfolio companies, which are defined as private U.S. firms or small public companies. For decades, the BDC remained a niche instrument, a quiet corner of the shadow ledger. However, the post-2008 regulatory metamorphosis hydraulically forced credit risk out of public banks and into these specialized structures. The BDC became the primary mechanism for large-scale direct lending, allowing asset managers to replicate banking functions without the burden of banking regulations. This is not a bank. It is a corporate entity that functions as a high-octane lending engine. Unlike traditional investment funds, BDCs are permitted to use leverage to amplify their returns. They are also structured to be tax efficient, paying little to no corporate income tax as long as they distribute at least 90% of their taxable income to shareholders. This requirement creates a constant pressure to originate loans and generate yield regardless of the underlying credit quality. The BDC legal frame is the foundation upon which the $2 trillion shadow is built, offering the illusion of a regulated investment while operating in the regulatory vacuum of the shadow ledger. By late 2024, the BDC sector had metastasized, with publicly traded and non-traded versions managing over $478 billion in assets. These entities have evolved from small business supporters into the preferred lenders for multi-billion-dollar leveraged buyouts. They are the dark equivalent of a commercial bank, possessing the power to issue debt, but lacking the oversight of a federal regulator. The legal frame was designed for the small, but it has been hijacked to carry the massive. Section 2. Leverage limit relaxation. If the BDC is the chassis, leverage is the fuel that drives it toward the cliff. For nearly 40 years, the shadow ledger was constrained by a strict one debt-to-equity ratio. This legal ceiling ensured that for every dollar of debt a BDC took on, it had to have a dollar of equity to absorb potential losses. It was a structural fuse designed to prevent a systemic explosion. That fuse was deliberately cut in 2018. Congress passed the Small Business Credit Availability Act, a piece of legislation that represents one of the most significant relaxations of financial oversight in the modern era. This act allowed BDCs to double their debt load, increasing the legal leverage limit from a 1:1 ratio to a 2:1 debt-to-equity ratio. This was not an incremental change. It was a total recalibration of the risk profile for the entire sector. The timing was a masterpiece of systemic failure. Regulators allowed BDCs to double their leverage just as the credit cycle began to mature and interest rates were at historic lows. This legislative gift provided the dry powder that fueled the aggressive competition for deals in 2020 and 2021. Managers, unencumbered by the old limits, raced to deploy this new leverage, often at the expense of underwriting standards. Pause this video right now. Open a browser and search for the SEC filings of the largest non-traded BDC in the world. Look for the leverage or borrowings section in their latest 10Q. Check if they have opted into the 2:1 limit. You will find that nearly every major player in the shadow ledger has hit the accelerator, leaving no margin for error when the market fractures. When you're ready, unpause. This relaxation of limits has turned the BDC into a highly sensitized instrument, At a 2:1 ratio, a minor decline in the value of the underlying loan portfolio can incinerate the equity cushion and trigger mandatory deleveraging. The safety of the 1:1 era has been replaced by a structure that is fragile by design, optimized for growth in a calm sea but doomed in a storm. The 2018 Act didn't just provide capital, it provided the mechanism for a non-linear collapse. Section 3. The Interval Fund Blueprint. While the BDC captures the institutional and high net worth market, a different vehicle was engineered to trap the retail investor, the Interval Fund. This is a specific blueprint within the Investment Company Act of 1940 that offers a lethal combination of illiquid assets and promised liquidity. Unlike mutual funds that trade daily or traditional closed-end funds that trade on an exchange, the Interval Fund does not trade. It is a semi-liquid vehicle designed to funnel retirement savings into the shadow ledger. The blueprint is simple yet deceptive. The fund invests in illiquid to 7-year corporate loans that have no secondary market. To attract retail bag holders, the fund offers to repurchase a small percentage of outstanding shares, typically between 5 and 25%, at periodic intervals, usually quarterly. This is the liquidity illusion. It provides a veneer of accessibility to assets that are, in reality, frozen. The danger is written into the fine print of the contract. If redemption requests exceed the 5% quarterly cap, the fund has the legal right to gate redemptions and prorate the withdrawals. This means you may only get 20% of the money you requested, while the rest remains trapped in the shadow ledger. This structure creates a prisoner's dilemma. The first person to the exit gets their money, while the rest are locked inside as the asset values decay. The Interval Fund is the primary vector for run risk in the non-bank sector. By 2024, these vehicles commanded nearly 1/3 of the US direct lending market. They have brought Main Street capital to the front lines of corporate credit risk. But when the credit cycle turns, the quarterly repurchase window becomes a behavioral trap, turning a manageable withdrawal into a systemic panic. The blueprint isn't for an investment, it's for a corral. Section 4. Resolution Divergence. To understand the ultimate risk of the shadow ledger, you must understand what happens when it breaks. There is a profound and clinical resolution divergence between a public bank and a private credit fund. When a regulated bank, like Silicon Valley Bank, fails, the state intervenes with surgical precision. The FDIC steps in as a receiver, utilizing the Deposit Insurance Fund or the Orderly Liquidation Authority under Dodd-Frank Title II to preserve the system. The goal is the continuation of credit flow and the protection of the public. In the shadow ledger, no such safety net exists. A BDC or a private credit fund is a corporate entity, not a bank. Its failure is not governed by the Federal Reserve, but by the cold, mechanical process of the US Bankruptcy Code. If a large-scale shadow lender becomes insolvent, it does not go to the FDIC. It goes to a bankruptcy court under Chapter 7 for liquidation or Chapter 11 for reorganization. This divergence is the kill shot for systemic stability. A bankruptcy trustee has no mandate to preserve the financial system. Their fiduciary duty is narrow and absolute, to recover as much cash as possible for the creditors. They will not provide a liquidity bridge or a soft landing. They will call in loans, seize collateral, and sell assets to the highest bidder. This is a world without a lender of last resort. While the Fed can monetize bank assets during a crisis to prevent a fire sale, it has no authority or political will to rescue a private credit fund. The BDC investor is an unsecured creditor in a complex corporate bankruptcy, with no SIPC or FDIC protection for their principal. When the chassis of shadow banking fractures, it doesn't get repaired, it gets sold for parts. Section 5. Fire Sale Externalities. The final fracture in the legal architecture is the fire sale externality. Because there is no liquid secondary market for private loans, a forced liquidation by one manager is not an isolated event. It is a thermal event that incinerates the valuations of the entire shadow ledger. In a bankruptcy scenario, the trustee must raise cash immediately. They are forced to sell illiquid assets into a market where there are no buyers, resulting in fire sale valuations of 30 or 40 cents on the dollar. These fire sale prices then become the new comparable for every other manager in the system. This is the hydraulic transmission of a crisis. Even if other BDCs are not failing, they are forced by accounting rules to mark their own portfolios down to reflect these new, distressed market prices. This triggers a wave of margin calls on their own leverage facilities, forcing them to liquidate assets to maintain their 2-1 ratios. The system is a giant circular dependency. One large manager's liquidation can trigger a non-linear, cascading collapse. We saw the first tremors of this in the failure of First Brands Group, which sent reverberations through the BDC sector as lenders raced to identify their exposure to a colossus of hidden leverage. When the orderly wind-down plans cited by managers are tested, they will be revealed as theoretical exercises that evaporate in the heat of a real liquidity freeze. The fire sale externality is the ultimate proof that the shadow ledger has not eliminated risk, but has merely concentrated it into a more explosive form. The lack of price discovery allows the pressure to build in secret for years. But when the legal chassis finally snaps, the repricing will be a cliff-edge event. The assets that were marked at par, 100 cents yesterday, will trade at liquidation value tomorrow, leaving the designated bag holder at the bottom of the abyss. These legal structures, the BDC, the interval fund, and the bankruptcy code are built to trap your capital the moment the tide turns. They were engineered to facilitate the flow of credit, but they lack the mechanisms to survive a withdrawal of confidence. In Episode 3, we reveal how these interval funds transform from income vehicles into behavioral traps designed to prioritize institutional exits over your retirement solvency. Like this video if you want the truth. Subscribe for the next dossier. We have now fully dissected the legal architecture of the system. We have seen the billions flowing through these vehicles. But that mastery of the structural frame naturally leads us to a much darker and more immediate question. If the system is this fragile and the leverage is this high, how are the managers reporting perfectly smooth returns every single quarter? In the next chapter, we expose the accounting black box of volatility laundering. We will reveal exactly how this system uses discretionary marks to hide market fractures and keep you in the dark until the slaughter begins. Chapter 4. Volatility laundering. To understand the crime, we must first inspect the weapon. In Chapter 4, we strip away the marketing facade of stability to reveal the accounting engine of the displacement, volatility laundering. We are stepping inside the regulatory and accounting black box to prove that the smooth returns reported on the shadow ledger are not a product of superior credit selection, but a systemic deferral of reality. Section 1. The ASC 820 Level 3 black box in the lit markets, the world of public equities and high-yield bonds. Price is a clinical daily execution. It is determined by the cold reality of observable trading. If a company's prospects dim or interest rates spike, the price of its debt falls instantly. This is price discovery. But in the dark markets of private credit, loans rarely trade. Because there is no active secondary market, these assets are shielded from the cleansing discipline of the tape. Under the framework of Generally Accepted Accounting Principles GAAP, specifically ASC 220 fair value measurement, the financial world is divided into a three-level hierarchy of subjectivity. Level 1 consists of assets with quoted prices in active markets for identical assets, such as Apple stock. Level 2 involves observable inputs other than quoted prices, like interest rate swaps. Then there is the basement of the architecture, Level 3 assets. The vast majority of the $2 trillion in private credit is classified as Level 3. These are assets valued using unobservable inputs that reflect the reporting entity's own assumptions about what other market participants would use to price the asset. This is not mark to market, it is mark to model. The fund manager is permitted to estimate the fair value using internal models, typically a discounted cash flow (DCF) analysis. This reliance on Level 3 inputs creates a circular valuation logic, a black box where the manager controls the inputs that determine their own performance fee. When you look at your alternative credit statement and see a straight line of positive returns, you are not looking at market performance. You are looking at a mathematical forecast developed by the very person whose bonus depends on that forecast remaining positive. The shadow ledger is built on a foundation of unobservable data, designed to remain opaque until the moment of systemic fracture. Section 2. The mechanism of the illusion. Why does this illusion exist? Forensic analysis proves that stability is a competitive necessity in the $2 trillion shadow. To attract and retain capital from pension funds and sovereign wealth funds, managers must demonstrate consistent positive returns with low volatility. A fund that honestly marks down assets during a market dislocation risks investor attrition to a competitor who smooths their returns. This is the engine of volatility laundering. The mechanism is simple. Managers adjust inputs like discount rates and exit multiples quarterly rather than daily. While public markets may be gripped by panic, private credit managers can argue that because they intend to hold the asset to maturity, temporary spread widening should be ignored. They decouple their net asset values as NAV from the vagaries of the interest rate cycle. Pause this video right now. Open the 10Q for a major publicly traded BDC, such as Blackstone's BC Cred or Ares Capital. Navigate to the Fair Value Measurements section. Find the table for Level 3 assets and look at the significant unobservable inputs. You will see ranges for weighted average cost of capital and exit multiples. Realize that a 1% shift in those unobservable numbers can incinerate or manufacture millions in reported equity. When you're ready, unpause. This smoothing effect artificially inflates risk-adjusted return metrics, such as the Sharpe ratio. By suppressing the reported standard deviation, the risk, the manager creates a statistical mirage, equity-like returns with bond-like safety. The stability of the asset class is self-reinforcing. Steady valuations attract more capital, which provides the liquidity to avoid realized defaults, further justifying the steady valuations. It is a hydraulic feedback loop of artificial confidence, sustained only by the manager's discretion. Section 3. Discretionary marks. The depth of this subjectivity is codified in the fine print of the accounting rules. ASC 820-105522 explicitly states that a Level 3 input can be a financial forecast developed using the entity's own data if no reasonably available information indicates otherwise. This grants the manager immense discretion over two critical variables: projected cash flows and discount rates. Under this rule, managers can use optimistic projections for a borrower's future EBITDA, assuming that current operational struggles are temporary. They employ adjusted EBITDA, adding back cost savings and theoretical synergies to inflate the enterprise value of the borrower. Forensic audit shows that removing these add-backs often reveals real leverage that is 2 or 3 turns higher than reported. This discretion allows managers to manage volatility even in the face of tectonic shifts in the macro environment. In 2022, as the Federal Reserve raised rates by over 500 basis points, the value of fixed income assets globally collapsed. Yet many private credit funds reported positive returns. They achieved this by arguing that because their loans were floating rate, the increased coupon offset the widening discount rate. This logic is a trap. It ignores the massive increase in credit risk, the probability of default, but higher rates imposed on highly levered borrowers. The manager is essentially marking the asset based on the contract while ignoring the solvency of the counterparty. This creates a class of zombie borrowers who are technically performing on paper but are fundamentally insolvent. The volatility of the default is laundered into a deferred revenue stream, keeping the lights on in the shadow ledger while the underlying foundation rots. Section 4. The valuation lag. The result of this discretionary marking is a systemic valuation lag. Empirical data reveals a delay of approximately 2 to 3 quarters between public market corrections and private credit write-downs. While public equity and bond markets reprice instantly to reflect new information, private valuations are sticky. This lag is measured through serial correlation or autocorrelation. In an efficient, liquid market, price changes are independent. New information is instantly absorbed. In the shadow ledger, valuations remain anchored to par. Research by AQR Capital Management and T. Rowe Price has quantified this effect, finding significant positive autocorrelation in private credit returns. This means that the return reported today is highly dependent on the return reported yesterday rather than today's market reality. This is not just a timing issue, it is a structural deception. The lag prevents the psychological distress of seeing red marks during a market correction. It provides accounting diversification, allowing a portfolio to look stable on paper even as the underlying economic value deteriorates in tandem with public markets. When researchers apply statistical unsmoothing techniques to remove this lag effect, the true volatility of private credit rises dramatically. Adjusted volatility estimates for private credit often range between 10 and 12%, placing it on par with the risky high-yield market. But the retail bag holder is never shown the unsmoothed data. They are sold the 2.9% volatility figure, the laundered figure. The danger of this lag is that it prevents gradual price discovery, ensuring that when the repricing finally happens, it will be a concentrated, non-linear cliff edge event. Section 5. The 2022 case divergence. The definitive proof of volatility laundering occurred in 2022. That year served as a real-world stress test that exposed the decoupling of the shadow ledger from economic reality. During the rapid interest rate hike cycle, the S&P 500 collapsed by 19%. The Bloomberg US Tellica aggregate bond index fell by 13%. Publicly traded leveraged loans experienced significant and violent volatility. In stark contrast, the private credit market reported a state of near-perfect calm. The Cliffwater Direct Lending Index, CDLI, which tracks thousands of private loans, reported a positive total return of 6.29% for the full year. It displayed virtually no volatility while the rest of the financial world was being incinerated. How is this statistically possible? Economic theory dictates that smaller, middle-market companies, the core borrowers of private credit, are inherently riskier than the large-cap companies in the S&P 500. They have less diversified revenue and limited access to capital. Therefore, a portfolio of these loans should exhibit higher volatility than public markets. The 2022 divergence proves that the reported stability of private credit is an artifact of valuation methodology. The riskier asset class reported less than half the volatility of the safer asset class. This is the statistical footprint of the crime. The lack of mark-to-market allowed zombie firms to be carried at par while their public equivalents were trading at 80 cents on the dollar. The 6.29% return was not a sign of resilience, it was a sign of price avoidance. The volatility was not eliminated, it was simply pushed into the future, where it continues to accumulate behind the dam of Level 3 accounting. Discretionary accounting allows the shadow system to defer reality indefinitely. We have seen how the black box of ASC 820 Level 3 provides the safe harbor for volatility laundering. We have seen the 2022 divergence, where private marks remained at par while the public world burned. Is mark-to-model just another term for mark-to-myth? Give us your take in the comments below. Mastering the mechanism of the illusion naturally leads us to a much darker and more immediate question. If the volatility is being laundered, what does that do to the statistics investors use to measure safety? In the next chapter, we dissect the Sharpe ratio, framing the lie. We will analyze the statistical consequences of this artificial stability and reveal why the next credit cycle will not be a correction but a slaughter. Subscribe for the next dossier. Chapter 5. The Sharpe ratio. Framing the lie. To understand the crime, we must first inspect the weapon. In Chapter 5, we deconstruct the statistical mechanism used to lure $2 trillion of capital into the darkness, the Sharpe ratio lie. This is the final structural pillar in the architecture of risk. We are moving beyond accounting entries into the domain of mathematical fabrication, revealing how the systematic suppression of volatility creates a statistical mirage of efficiency that masks a terminal vulnerability. Section 1. Suppressing the denominator in the global coliseum of asset management, the Sharpe ratio is the ultimate metric of performance. It is a simple calculation: excess return divided by the standard deviation, or the risk, of the asset. To a forensic auditor, however, this formula is a playground for deception. In the shadow ledger, the numerator, the return, is curated by the manager's discretion. But it is the denominator, the volatility, where the real crime is committed. By employing volatility laundering, managers artificially suppress the denominator of the Sharpe ratio. When you report a smooth, straight line of returns, your measured standard deviation collapses. In the lit markets, an asset returning 10% with a 15% volatility is viewed as risky. But in private credit, by marking assets to a model that ignores market fluctuations, the manager can report that same 10% return with an engineered volatility of only 2.9%. This is not math. It is a lie designed to double or triple reported efficiency. By suppressing the denominator, private credit funds present a compelling but illusory case for alpha over public markets. They offer investors the free lunch of finance, high returns with bond-like safety. Forensic analysis proves this alpha is merely an artifact of infrequent and subjective pricing. The risk has not been eliminated. It has been hydraulically forced out of the formula, creating a statistical vacuum that will be filled by a catastrophic liquidation when the market finally fractures. Pause this video right now. Open your investment portal and find the risk/reward or Sharpe ratio metric for any private debt or direct lending fund. Now search the prospectus for the term standard deviation and look for a figure under 4%. You are looking at the statistical footprint of a lie. When you're ready, Section 2. The riskier asset anomaly. To expose the lie, we must apply the discipline of theoretical logic. Economic theory dictates that risk and return are inextricably linked. Smaller, middle-market companies, those with EBITDA between $10 million and $100 million, are inherently more fragile than the large-cap giants of the S&P 500. They possess less diversified revenue streams, limited access to capital, and extreme sensitivity to economic shocks. Therefore, a portfolio of these loans must exhibit higher volatility than the public, broadly syndicated market. The data reveals a stark anomaly that defies the laws of financial gravity. As of late 2024, the Cliffwater Direct Lending Index, CDLI, which tracks thousands of these fragile middle-market loans, reported an annualized standard deviation of approximately 2.9%. In contrast, the Morningstar LSTA US Leveraged Loan Index, which tracks the debt of larger, more stable corporations, reported a volatility of 6.5%. The riskier asset class is reporting less than half the volatility of the safer asset class. This 55% variance is the statistical smoking gun of the shadow ledger. It is mathematically impossible for the underlying economic risk of middle market debt to be lower than large cap debt during a period of 500 basis points of interest rate hikes. This discrepancy is entirely attributable to the valuation methodology, a mark-to-model regime that permits managers to ignore the technical selling pressure and sentiment-driven pricing that characterize the real world. The anomaly is the proof. The stability of private credit is a manufactured illusion. Section 3. Autocorrelation coefficients. The mechanism of this artificial stability is serial correlation, or autocorrelation. In a liquid, efficient market like the S&P 500, price changes are independent. New information is instantly and violently absorbed into the tape. In the dark markets of private credit, however, valuations are sticky. A manager does not take the full hit of a market correction in quarter. Instead, they adjust the valuation of a loan over several periods, effectively leaking the bad news into the ledger. Research by AQR Capital Management and T. Rowe Price has quantified this lag, finding significant positive autocorrelation coefficients in private credit returns. This means that the return reported today is highly dependent on the return reported yesterday, rather than today's economic reality. This smoothing effect creates a systemic valuation lag of approximately 2 to 3 quarters between a public market correction and a private credit write-down. When forensic researchers apply statistical unsmoothing models, such as the Geltner or Getmansky-Low-Merton models, to remove this lag, the true volatility of private credit is incinerated into view. Adjusted volatility estimates do not hover at 2.9%, they rise dramatically to between 10 and 12%. At this level, the free lunch evaporates. The asset class is revealed to be on par with, or riskier than, the high-yield bond market. The high-Sharpe ratio is exposed as a framing device, a mathematical trick used to justify the extraction of performance fees while the underlying credit quality rots in silence. Section 4. The Cliffwater Line Fracture. We must now visualize the point of failure, the Cliffwater line. This is the benchmark used by the industry to validate the stability of private credit. But the Cliffwater line is cracking. It fails to account for the 55% variance in true volatility when compared to liquid benchmarks like the LSTA. During the 2022 market stress, while the S&P 500 fell 19%, the CDLI reported a positive total return of 6.29%. This divergence is the fracture point where the shadow system decouples from reality. The Cliffwater line is an artifact of mark-to-model accounting that avoids sentiment pricing. While proponents argue this reflects true fundamental value, forensic audit proves it masks credit deterioration. The line remains straight only because the manager controls the inputs, the discount rates and the exit multiples. In 2022, as the Fed raised rates by 500 basis points, the value of all fixed income assets collapsed, yet the Cliffwater line remained anchored to par. This decoupling creates a dangerous arbitrage. If the public market prices for similar debt are trading at 85 cents on the dollar, but the Cliffwater line carries them at 98, a rational investor will rush to redeem their shares at the inflated NAV. This dynamic precipitates the very run risk that shadow banks are structurally unable to survive. The fracture in the Cliffwater line is the warning signal. When the lag ends, the convergence will be violent. The straight line is not a sign of safety. It is the path of a projectile that has not yet hit the ground. Section 5. The calm before the slaughter. We are currently in the calm before the slaughter. The total absence of price discovery in the shadow ledger has created a cliff edge repricing risk. In a transparent market, assets decline in a downward slope, allowing for gradual deleveraging. In private credit, assets remain at par until the precise moment of a hard default or a forcing event, such as a regulatory audit or a liquidity crunch. This is the binary behavior of Level 3 assets. They are marked at 100 today and 40 tomorrow. We saw this in the restructuring of Pluralsight. where different BDCs marked the same senior secured loan at 97 cents and 83.5 cents simultaneously, only for the value to plummet to 46 cents once the keys were handed to the lenders. The golden age of private credit has been sustained by a regulatory and accounting arbitrage that permits the indefinite deferral of reality. This deferral is the mechanism of the trap. By the time the Sharpe ratio lie is exposed by a realized default, the liquidity will have already evaporated. The $2 trillion shadow has no lender of last resort to monetize its illiquid assets. When the slaughter begins, the repricing will be non-linear and catastrophic. The assets that were marketed as stable and low volatility will be revealed as the most fragile instruments in the global architecture, leaving the designated bag holders at the bottom of the cliff with no way back up. Okay, so Episode 1 has exposed the $2 trillion architecture of risk built on regulatory arbitrage and the Sharpe ratio lie. We have seen how synthetic stability and mark-to-model accounting mask the true state of the shadow ledger. We have established that the free lunch of private credit is a mathematical fabrication designed to displace risk into the darkness. In Episode 2, we expose the Ponzi engine. We will move inside the operational reality of firms sustained by non-cash lifelines. We will examine the payment-in-kind interest epidemic that conceals unserviceable debt. We will dissect the rise of zombie companies and reveal how AI startups use round-trip debt to fabricate revenue. Keep an eye out for Episode 2 dropping this Wednesday. Don't forget to subscribe so you don't miss the next one.